You've been told the RV market is recovering. But why are 25% of dealerships closing forever?
Factories are closing, workers are getting laid off, sales are declining, profits are down, and diesel RVs are about to get banned in multiple states.
Factories kept building, dealers kept taking shipments, but customers stopped buying. Now showrooms sit quiet, floor plans rack up interest, and family-run stores bleed out. Every new arrival on the lot is another nail in the coffin. So what does this mean if you own an RV that's losing value by the week? What happens when the only service center left is 200 miles away? And what will it cost your family when financing terms turn from tough to impossible? Because by the end, you'll see, the RV apocalypse isn't coming. It's already here. Shipments rising, sales falling, the dangerous mismatch. This is not growth, it is a trap. On the surface, the shipment numbers look healthy, even impressive. Industry trackers reported double-digit gains in recent months, a welcome change after years of contraction. But behind the spreadsheets lurks a dangerous mismatch. Dealers accepted deliveries because factories kept rolling product off the line, not because customers were standing ready with cash in hand. Lots filled with gleaming new models, while showrooms stayed eerily quiet. The trap is simple. Shipments rising while sales fall means inventory sits longer, tying up cash and draining credit lines. Floor plan interest rates are higher than they have been in nearly 2 decades, so every unsold rig is a weight around a dealer's neck. The public sees headlines of growth, but insiders whisper about mounting backlogs and desperate discounting. Every extra shipment is another brick in a wall of financial strain, and the cracks are beginning to show. And when you look at how we got here, the story becomes even darker. The overproduction hangover comes due. The highway is still blocked, and dealers are paying the toll. During the pandemic, factories ramped up production at a furious pace. Demand seemed endless as families searched for outdoor escapes. Assembly lines roared, churning out travel trailers, fifth wheels, and motorhomes in record volumes. It felt like a golden age, but the golden age ended abruptly, leaving behind a massive traffic jam of unsold inventory. Imagine a 6-lane freeway suddenly narrowed to 1. Vehicles inch forward, bottlenecked and stuck. That is what the RV industry faces now. The overbuild created yards filled with units that took months, even years, to clear. Dealers bought heavily, assuming the boom would never slow, and now the jam is impossible to ignore. Manufacturers keep pressing shipments to maintain revenue, while dealers are left carrying the debt. The backlog has become a hangover, and no one knows how long it will last. But if the overbuild created the jam, the product mix determined who could keep moving and who would stall completely. If you're seeing how deep this collapse runs, hit like right now so more people can see what's really happening. And drop a comment with your take, because your voice matters here. Motorhomes bleed, towables tread water, luxury rigs are sinking, only trailers are staying afloat. Motorized units, once the crown jewels of the industry, now bleed market share month after month. These high-ticket vehicles depend on affluent buyers with access to cheap financing. That world vanished when interest rates climbed, and suddenly the motorized segment looked less like a dream and more like a dead weight. Towables, by contrast, remain a lifeboat. Travel trailers and fifth wheels continue to move, not at boom-era levels, but at a pace that keeps some dealers breathing. Their lower upfront costs, simpler mechanics, and broader appeal provide resilience in a storm. Families still seek affordable ways to camp, and towables answer that call. Yet even here, margins are thin, and competition is fierce. Survival depends on volume, not profit, and only the leanest operators can hold on. And while products struggle on the sales floor, factories themselves are rewriting their playbooks to stay alive. Mergers at the factory, survival by combination. Behind closed factory gates, brands are vanishing into families. The survival strategy now is combination. Thor Industries quietly folded Heartland into the Jayco umbrella, eliminating duplication while retaining brand labels for dealer contracts. R-vee Group retreated from towables altogether, selling the Landscamper division to Vision Corp. Each move reflects a stark truth. Growth is no longer the goal, survival is. These mergers reshaped the portfolio of entire corporations. What looks like a wide marketplace is, in fact, a shrinking set of players hiding behind multiple badges. To the consumer, variety still appears abundant, but insiders know many of these models share the same engineering, the same parts, and increasingly, the same identity. The consolidation is not cosmetic. It is existential. Factories must either merge, sell, or vanish. And that factory reshuffling sets the stage for the next crisis, the erasure of local rooftops where buyers once found real choice. 1 in 4 dealerships erased. A quarter of the map is about to go dark. Across North America, roughly 1 in 4 RV rooftops is expected to vanish in this cycle of collapse. For some, the ending will come in the form of shuttered lots and locked gates. For others, the disappearance will be quieter, absorbed into larger groups and rebranded beyond recognition. Either way, local independence is being erased. The wipeout is not theoretical. Smaller dealerships struggle to pay floor plan interest, handle rising insurance, and manage staffing as margins vanish. Unlike national chains, they lack capital buffers or private equity backing. When shipments continue to arrive but sales lag, their balance sheets implode. The numbers spell extinction for many family-owned stores that once anchored small towns. It is not just about losing a business. It is about erasing community hubs where generations bought their first trailers. And as these rooftops vanish, the players sweeping in to fill the gaps are not mom-and-pop operators. They are giants. The era of roll-ups, chain swallow independence. Your family-run dealer? Tomorrow, a corporate logo. The new era is defined by roll-ups, where national chains buy independent stores at a rapid pace. Groups that once held fewer than 20 stores now chase footprints of 100 or more. Their strategy is simple: grow fast, spread overhead across multiple rooftops, and dominate regional markets. For customers, this shift means familiar storefronts take on new names. The salespeople might stay, but the culture changes. Decisions on financing, inventory, and marketing come from distant headquarters rather than local owners. The takeover creates efficiency, but also strips individuality. To investors, roll-ups are smart consolidation. To communities, they feel like invasions. The unique local flavor of RV shopping, knowing the owner, trusting the service manager, gives way to standardized corporate branding. But while roll-ups explain part of the story, they cannot hide the deeper paradox. Closures can occur even in moments that look like growth on paper. Closures during a boom, the profit illusion. Sales can rise, and rooftops can still fall. On the surface, shipments create the illusion of strength, with factories reporting gains and headlines praising recovery. Yet profits at the dealership level remain fragile. Some stores shut down precisely when the market appears to be climbing. The paradox is painful but predictable. Shipments increase, but retail demand fails to keep pace. Dealers caught in this mismatch bleed cash. They discount aggressively, drain reserves, and eventually fold. National roll-ups may absorb a few, but many simply vanish. The illusion of a boom hides the truth of local shutdowns. For employees, it feels like betrayal. For customers, it looks like chaos. A shiny lot one week becomes an empty gravel yard the next. The narrative of recovery is paper-thin because profit margins, not shipments, determine survival. And even for those dealerships that endure, the product lines they offer are morphing into something unsettlingly uniform. Homogenized brands, vanishing choices, different names, same R-vee, and your choice just shrank. Dealers increasingly sell lines that look unique on the surface but share identical parts beneath. This homogenization comes from manufacturers desperate to reduce costs and streamline production. What once were distinct models now become clones with different badges. To buyers, this feels like deception. Walk through one showroom and see a floor plan. Visit another brand down the street and find the same unit with a new nameplate. The illusion of variety erodes trust and diminishes the joy of comparison. For dealers, homogenization simplifies stocking and service, but it also weakens differentiation. Customers sense sameness, and loyalty fades. The badge may still shine, but the identity behind it has been diluted. The marketplace narrows, not in quantity of labels, but in substance of choice. And with local rooftops closing, chains expanding, and identities blurring, the stage is set for consumers themselves to feel the squeeze most directly. Financing turns into a trap. It is not the sticker, it is the monthly no one can carry. Buyers once dazzled by glossy paint jobs now stall when they see the financing terms. Interest rates have more than doubled compared to the boom years, and loans stretch longer than ever. A motorhome that once looked attainable with a manageable payment now feels like a trap. Dealers face the same squeeze on their floor plan loans. Every unsold unit drains cash as interest compounds. This financial vice grips both sides of the market. Customers hesitate, and dealers grow desperate to move product. Promotions, incentives, and dealer discounts slash margins, but still buyers balk at signing contracts. The industry that thrived on cheap credit now feels the sting of expensive debt. As payments spiral, even families willing to stretch their budgets reconsider. The trap is not imaginary. It is visible in every stalled deal and every unit languishing on a lot. And when new rigs slow to move, attention shifts to the used market. But that safety valve is about to crack. Used values, the crown slips in autumn. Strong today, worth less tomorrow. For years, used RVs held their value unusually well, buoyed by high demand and scarce supply. Auctions were busy and wholesale prices climbed. But seasons always change, and autumn delivers a predictable chill. As dealers mark down new inventory to clear the way for the next model year, used values inevitably decline. Wholesale auctions show the first tremors. Dealers offload trades quickly, fearing they will sink in value if they linger. Families who bought used units at peak prices now face the painful reality that resale will fetch less. The crown of the used market slips each fall, and in a cycle this fragile, the decline cuts deeper. Confidence erodes when buyers realize the RV they purchased last spring is suddenly worth thousands less. The market does not forgive overpayment, and autumn is the cruel reminder. And while values fall on paper, the human toll lands hardest in the plants, where layoffs announce the next phase of the squeeze. Layoffs don't lie. Factories feel the freeze. The assembly lines are silent, and so are the paychecks. Factory layoffs cut through the heart of RV country. From Indiana to Oregon, WARN notices post on bulletin boards, giving workers 60 days to prepare for unemployment. Families who relied on steady shifts to pay mortgages and school fees now face shuttered plants. Layoffs never lie. They reveal what sales reports obscure. Behind every upbeat statement about shipments or new models is the truth of shrinking demand. When hundreds lose jobs, it is clear the industry is freezing. Communities built around RV manufacturing feel the shock instantly. Grocery stores sell less, diners see fewer customers, and local charities brace for more need. The freeze does not stop at the plant gates. It spreads across towns like a chill wind. And as layoffs expose the weakness, the factories themselves pivot, shedding divisions and selling brands to cling to survival. Strategic retreat, when builders sell to survive. Growth was yesterday, survival is today. Manufacturers once boasting about expansion now quietly divest. R-vee Group abandoned the Towable segment, selling Lance to a private firm. Thor folded Heartland beneath Jayco, cutting duplication and shrinking overhead. These are not bold expansions, but tactical retreats. A strategic retreat can buy time, but it carries a cost. Each sell-off signals vulnerability, and each merger reduces variety. The once broad portfolio narrows to a handful of survivors. For dealers, that means fewer options to stock. For customers, it means sameness disguised as choice. For workers, it often means relocation or unemployment. The retreat is not optional. It is survival in its rawest form. Factories divest because the alternative is closure, and with finance trapping buyers, used values sliding, layoffs multiplying, and factories retreating, the stage is set for the ripple effects that will reshape politics, labor, and communities far beyond the RV lot. Policy can't save a payment. No law can lower your APR. Policymakers can debate tariffs, stimulus, or tax credits, but none of it reduces the interest rate on the loan staring a family in the face. Inflation lingers, and the Federal Reserve keeps rates elevated, making credit expensive for both buyers and dealers. The cost of imported materials, worsened by tariff battles, adds even more to sticker prices. Policy might promise relief in speeches, but the numbers in the finance office tell the real story. The lesson is sobering. Governments can shape the environment, but they cannot erase the arithmetic of borrowing. For many households, higher rates mean a dream of owning a motorhome is shelved indefinitely. Dealers hoping for policy rescue learn the same truth. Survival depends on economics, not rhetoric. This is why talk of recovery feels hollow to those calculating real monthly payments. And when families discover policy cannot fix the math, the pressure shifts to labor, where workers refuse to stay silent in the face of shrinking security. When jobs vanish, workers push back. The line is gone, but the picket remains. Layoffs and plant closures trigger anger. Workers are organizing. Across RV towns, protests rise outside shuttered facilities. Signs call for fairness, unions gain ground, and the backlash against corporate restructuring grows louder. Even employees spared from layoffs fear they are next, and that fear turns into collective action. Labor movements intersect with a new era of corporate responsibility. Executives tout environmental and social goals in glossy reports. Workers demand tangible commitments, jobs, wages, and dignity. The disconnect fuels resentment. Families who built these companies feel discarded, while management speaks of efficiency. The picket line becomes both a protest and a warning that workers will not quietly accept endless retreat. Communities back them, knowing each lost job weakens the entire town. Workers are also turning to digital platforms to amplify their voices. Social media campaigns highlight layoffs, spreading stories beyond local picket lines and attracting national attention. This visibility pressures corporations to respond faster, while rallying public sympathy. What once stayed confined to factory gates now sparks conversations across the country. And as labor pushes back, investors watch closely, not for sentiment, but for signals about where to place their bets. Wall Street bets on giants, not families. The market does not care about memories. It cares about margins. Wall Street investors flock to the giants, backing national chains and major manufacturers that can wield scale. Capital flows to those with the largest footprints, the deepest balance sheets, and the broadest portfolios. Small, independent dealers find no such support. To investors, they are risks, not opportunities. This bet on scale has logic. Larger groups negotiate better terms, spread overhead, and withstand downturns longer. Yet cracks appear. Integration is messy, customer service suffers, and communities sense the loss of local character. Wall Street shrugs at these costs, so long as quarterly results hold steady. The divergence is stark. Investors grow richer, while small-town families lose autonomy. The capital tide is not sentimental, and it is rewriting the retail landscape at speed. And while capital flows to the giants, individual consumers still have tools to protect themselves. If they know how to play the game, we're only scratching the surface of what's coming. If you don't want to be blindsided when the next wave hits, subscribe now. That way, you'll never miss the updates that matter most. Because the collapse isn't slowing down, and neither are the stories you need. How to survive the R-vee apocalypse. The collapse is real, but you can outsmart it. For consumers, survival means strategy. Timing purchases is critical. Autumn and winter often bring discounts as dealers clear old stock, while spring shows inflate prices. Protecting equity matters just as much. Maintenance, careful record keeping, and choosing towables over high depreciation motorhomes can preserve value. Planning ahead for service is another key tactic. As rooftops consolidate, warranty slots grow scarce. Booking early and building relationships with service managers can prevent months of delays. Consumers who approach the market with patience and strategy still find opportunities. The apocalypse does not erase camping dreams. It simply demands sharper decision-making. Families willing to adapt can turn a volatile market to their advantage. Survival is not about denial, it is about preparation. Adaptability also means watching broader economic signals. Rising fuel prices, shifting interest rates, or new tariffs can change ownership costs overnight. Families who track these indicators can anticipate when to buy, when to wait, and when to refinance. Awareness turns uncertainty into leverage, giving consumers control in chaotic times. And with policy powerless, workers mobilizing, Wall Street consolidating, and consumers strategizing, the story of the R-vee industry enters its next uncertain chapter, one where resilience will matter more than ever. The collapse isn't coming. It's already here. Dealerships vanish, workers fight back, and the entire system rewrites itself while most people look away. Don't be one of them. Hit subscribe right now because the next chapter is already unfolding, and you need to see it first. Miss it, and you'll miss the one insight that could change how you survive tomorrow.